Hi there, everybody. It is time to get started, and we appreciate you being here right on time today. That really helps. And by the way, thanks also for taking time out of your weekend. Very nice to see you in our room today. This is Craig at Max Trading, here along with Chris and Eusebio, and we are so pleased to include you as part of the Max community today. By the way, this is a really good trading community. It's lots of fun, lots of support, and lots of assistance available. And just for an example, this past September, a few weeks ago, I came across a trading idea here that gave me an extra 3,000 pips for this month of October. Very nice. The markets, of course, are always in a state of change, and new ideas can be very important to help us out. It was more than 4 years ago now that Eusebio first saw the need for a reliable indicator that would help to deal with the changing flow of price in the markets, the differences in ranges. We do believe that it's important that you get to see our trading methods in real-time price action on live charts. And so you are also invited to attend our next NFP trading session coming up shortly now. And because you registered for this session, you are automatically included in the real-time trading session, and there'll be more information about that later. It gives you a chance to see for yourself the effectiveness of the Max trading system and of our new indicators, and you are welcome to attend. We hope that you can, but if not, we'll make sure that you get the video playback. Eusebio is the developer of the ETF as well as the companion, and that makes him the ideal choice to take us deeper into the world of Max trading. He is a phenomenal trader, very skilled, also an excellent teacher, and I think you will appreciate, even today, his passion for helping traders become successful. So Eusebio, we really appreciate everything that you do for your fellow traders, and it's a pleasure to pass the microphone along to you.
Thank you very much, Craig. Hello, everyone. I hope you are all doing fine, and I'm really glad to see a lot of people present for this presentation today. Before starting this presentation on my part, on my side, I would like to make a quick video and audio check. Do you see my screen? I'm showing my PDF, and do you hear me well? If you would like to type a yes or a Y in the question area of GoToWebinar, I would really appreciate. Oh, I see some yes coming very fast and good. Yes and good. Okay. I recognize some Max graduate also in the room. So thank you for your participation today. Okay, just before starting describing what the Max is and to give some examples. So let me give you a very quick background of who I am. You have perhaps recognized through my accent that I am a European person. I live in France. I'm a Belgian trader, but I live in France now. And so I am a full-time Forex trader since 2008 with the Max, and a Max instructor since 2009 after Dr. Jim Pruitt passed away, in fact. But my previous career was in the IT industry. I was a software engineer and services manager, and I have practiced that almost 30 years, and 15 last years I have had the opportunity to work with some important banks here in Europe, which has given me the opportunity to be in contact with some traders from whom I have learned something in trading. So, but I have also a larger experience in investing and trading for more than 30 years now. So in the stock market, in the options market, in the futures market, and since 2000 in the Forex market. So what I will present today is just what the Max ETF trading system is, with some of its concept, and I will illustrate this concept with some example of recent and past trade, and then I will talk just a little bit about what we can do with an appropriate money management associated with the MAX. So a small history about the MAX. The MAX trading system has been created many years ago by late Dr. Jim Pruitt, known by his student as Tiger because of very strong temperament, but strong temperament because knowing his time was counted, he was fast to try, he wanted to be fast to transmit all his experience and knowledge to his students. So with the aim to give his students a very powerful but also reliable and flexible trading method. But if that trading method is based on simple concept, it is not so easy to apply. It requires to develop two keys to become successful with the MAX: work and commitment. The courses, whatever the level you may take, are very intense, and so they really require a lot of work to assimilate all the contents and to learn applying correctly all the rules and these contents. And so they require a lot of commitment. So it requires time investing. And so, of course, the aim of trading is to make money, but if making money is your only motivation, believe me, this will not be enough to invest the time and the effort which are necessary for the work which is necessary to master the MAX. Chris will talk a little bit about that later when he will take the mic. But there are also other skills to develop: discipline, patience, persistence, concentration, and confidence. Discipline and patience seems obvious. The MAX is based on rules to take decisions, and each rules represent, in fact, either for an entry or an exit, a set of conditions we need to check before taking that decision. The decision may be to open a trade, maybe to partially close a trade, maybe to add to a trade, or maybe to close the trade. And so we need to wait for all the corresponding conditions to be fulfilled. And so this requires patience and discipline, but it requires also persistence. Persistence is an important key because we don't have, of course, a 100% winning rate. So we will face and we will have losing trades. And you need to know that, in fact, the losing streaks are usually larger than you can imagine. It is very common with many traders to jump from one system to another after testing it and facing 2 or 3 losing trades in a row. But even with a high winning rate system, for example, a 70 or an 80% winning rate, you may still face losing streaks made of 5 to 10 losing trades in a row, 10 losing trades in a row. And I know that by experience, my own largest losing trade is 6 losing trades in a row. And I know for sure, because these are the statistics on trading system, I know for sure that one day I will have 7 or 8 or 10 losing trades in a row. Concentration also is important because the MAX contains a lot of details we have to pay attention. And so especially when we trade with the small time frames, higher time frames is easier, of course, it requires less concentration, and so we need to focus on all these details we can see on a chart or outside a chart. And confidence, we need to develop confidence in the market itself, in its ability to provide every day enough opportunities to trade, confidence in the MAX itself, in its ability to catch many of these opportunities, and confidence in ourselves, in our ability to apply correctly the concepts and the rules of the MAX. And this can be acquired by practicing, in fact. And so when we want to define a trading method, there are several points we have to pay attention. So, in fact, we need to define what a trend is. We need to define what are the movements we want to catch and to trade. Then we have to define how such a movement may possibly start. And so for that, we will define some setups. We will have to define also when such setups are valid. And in fact, with the MAX, we have 3 types of validation. We have a technical validation, a technical level validation is the pattern, or are the pattern we consider as setups technically valid. We have to consider also the risk aspect. This is the second type of condition. Is the risk appropriate or not? And then the most important one, we have to check that the global context is in agreement with the trade we want to take. And the global context is most probably the most complex aspect of any trading system. The global context creates the condition for the market movements. And so the global context contains the news release, contains the decision made every day by the central banks, contains the influences of the geopoliticals, and so on and so on. And so each of these aspects will help you to define what is the most plausible directional bias every day. And so you will have to consider trades only in the same direction, of course, in order to optimize your winning rate for the trade you will take and to get, in fact, high probability winning trades. And then we have to define, of course, once a trade is open, how to handle that trade. How can we add to the trade? How can we scale out from the trade? And so how to progressively reduce or cancel the risk we have once we have opened the trade until we get a risk-free trade, at which point we can then consider to optimize the profit from that trade. And then finally, we will have to define how a trend we are trading can possibly exhaust. I don't say intentionally reverse, because a trend exhausting will not necessarily reverse. It may possibly reverse, but it can range for a long time period, and it can also resume its trend after some long range behavior. And so, but the exhaustion is important because it will be a good point to close a trade. So with the MAX, we will consider all these aspects, how to define and how to trade a trend, in fact, because the MAX is a trend following system. And the MAX, in fact, is the abbreviation of three important concepts. It's an acronym. And so the M stands for momentum. We want to open a trade only when we have enough momentum in the price. Enough momentum, but also enough volatility, because a movement is created by momentum and volatility. The A stands for acceleration. Acceleration here means that at some point along the trade, we will be able to add to the trade to progressively build a larger position. This is called the scaling technique. And doing so, we will be able to extract more profit from the same movement we are trading. So, and doing so, we will have to control the risk on the trade to keep that risk acceptable for the trade. And the X stands for exit, and we will have two types of exits: minor exit or scale out, and final exit. And I will illustrate that on some example I will show in a moment. And so I have said that the MAX is essentially a trend following method. In the classic MAX, before we introduce the ETF concept, we have been able to define also how to trade counter-trend movement and some types of consolidation area, which is still possible, of course, with the MAX ETF. Everything which is possible in the classic MAX stays valid in the MAX ETF, of course. And the MAX is associated with a very strict trade risk management and money management system. So in order to accept, or in order to define an acceptable risk when we open the trade, to keep that risk at an acceptable level until it is completely cancelled while we are in a trade, and money management rules to grow safely the trading account when everything goes nicely, and to control the drawdown when we are facing losing streaks. And so on that point of view, so the MAX is applicable to any time frame and to any market, not only the Forex market, of course, but also the futures market, the commodities market, the stock market, the options market. If we can trade stocks, we can trade options when the stocks is optionable. So if the MAX is a trend following method, it is not a scalping method. We are not interested to try to cut just a few pips in the shortest possible time period. I don't agree with that idea that longer we stay in the trade, higher is the risk to see that trade reverse and become a losing trade. If you understand the reason why a movement you are trading is unfolding, there is no risk at all, in fact. So the MAX is not a scalping method, and it is not a news trading method. We don't try to catch these fast spikes we see on the market when we have a big surprise in an important news release, because these fast spikes, first of all, are too fast, and when we try to trade it, we will get systematically bad price execution. And we have also another reason of bad price execution is we have also a very important increase in the spread in the price we get when we are executed. So we don't trade the news, but we can trade, of course, the movement after the news release, once the news has been released with the appropriate conditions. So, and it is not an elementary buy and sell system. It is not a system, for example, given with just one indicator printing on your chart, green and red arrow on your chart. You will have to learn and apply the concept and the rules coming from these concepts. So you will have to think about what is happening on your chart. And so what is an entry setup now? As I have said so just a few moments ago, an entry setup is defined as a group of conditions based on technical aspect, risk conditions, and global context. And an exit setup, on the other side, is not defined as a way to predict that the price will reverse, but it is defined as a moment in the price movement when that price movement creates a possible risk for the trade we are handling. And we have several types of exit setups. We have exit setup based on technical indicators, based on pure price action behaviors, based on a combination of technical indicators and price action, based on timing aspects, and based on the concept of movement in validation, and finally also with trend reversal, because sometimes we may see a trend reversal, of course. And so we get a lot of exit techniques in such a way in order to try, and this will happen most of the time, to try to have the best exit we may have along our trade in order to reduce the risk and to bank some profit, of course. Before showing some example, I would like to mention the different challenges we may have with all trading, with all trend following system. Sometimes, depending on the market conditions, we may have small price movement. And when we have small price movement or poor price action, it's extremely challenging to extract some profit from these too small movements. When the price moves in a range of less than 20 pips during the entire day, if you make intraday trading, so it's extremely difficult to extract profit along the day. Sometimes when we have trend following system based on some indicators, for example, we may miss some ample movement because the price sometimes will reverse very quickly. And because the indicators have some lag, of course, we may miss some such movement. And so in a trending system, usually we define what is a trend and what is a counter trend. But personally, I have never been entirely satisfied with such classification between two types of movement. For me, a movement is a movement and it can be considered as a trend. And so within the MAX, we have a few years ago redefined completely what we call a trend, and this has been made with the ETF concept, as I will show in a moment. And sometimes when we use time bar chart, for example the 5-minute time frame, the 15-minute, the 1 hour, the daily time frame, we can have a loss of details in the chart because we need to wait for the bar to close possibly before taking some decisions. And so we have a time lag in the decision we have. And so we can use other types of charts also to make finer or to analyze finer details on our charts. Another challenge, which is due to which is linked to the small movement we are seeing, is if you remember in 2008, so with the subprime crisis, we were seeing tremendous movement. It was not uncommon to see trades making several hundred, sometimes several thousand pips per day due to that financial crisis. And since that moment, or 1 or 2 years later, when the volatility has begun to decrease, we have observed, in fact, a continuous decrease of the average daily range over years, with sometimes some increase of this average daily range, but from a high average daily range, we are now at a very low average daily range. And so when we have very small movement along the day, it may be a challenge. And this is not only true for the major pair, but it is true also for the other crosses we may trade with the MAX. And you can see that the average daily range is in fact cyclical by nature, and for the moment we are at the low levels of this cycle. So, but soon, with all the problems we have all over the world, we will see that momentum and that volatility increasing again for the best profit of any trading system exploiting trends. So in order to overcome all these challenges and to self-adapt to the market conditions evolution. So we have introduced the ETF concept in the MAX a few years ago, and now since last year the ETF concept has been introduced, as Craig has mentioned, in all levels of the MAX, especially in the two levels we propose to you today, which are the MAX ETF Primer and the MAX ETF Standard. I will show the distinction between these two levels in a moment. So that ETF concept and its companion bias directional indicator has the aim to be able to catch more movement to trade and to catch larger movement when this movement happens. It is interesting to know, for example, that every pair on average in intraday trading will develop 2 or 3 times per week what I call a true trend. And a true trend for me is a movement with some types of size or larger, for example, more than 50 or 60 pips. So starting at some specific point during the day. And so with the MAX, as I have said, we will combine also the classical trend and the classical counter to trend movement, and they were defined in the classic MAX into a unique directional momentum movement. So what kind of result now can you expect from this new MAX ETF when it is compared to the classic MAX? So let's see just some example. This was an example made last Friday, so yesterday, with the pound kiwi, but the movement you are seeing here is equivalent to several of the other pairs, like the pound yen, like the pound Aussie. And so on this chart, I'm going to explain the different elements we are seeing. Let me take my red spot here. So this orange vertical line represents here the Tokyo Open and then the Frankfurt and the London Open here. And then you have also on the chart several horizontal lines representing what we call max price levels. These max price levels are produced every week, every Saturday, and especially on this chart, these levels have been produced last Saturday, so 1 week ago. And we can see that the price, right with the Tokyo Open, the price was sitting on that max price level, and so has developed an uptrend, and the price has achieved the upper level here, almost on the pip before reversing. And in fact, what the price has made after that, the price has ranged somewhat, and later in the US session and the second part of the European session, the price has reversed into another nice downtrend. You see also some indicators. We have, for example, moving averages. This one in blue aqua is a long-term moving average, and the small gold one here is a small moving average, a small time moving average. And then we have an example of one of the indicators we use for some types of our exit techniques. And we have two important sets of indicators. We have here two lines, one in yellow and in orange, which is called the ETF lines, which is extremely close to the price action itself, and which reverses extremely fast just after the price reversal itself. And these two lines are extremely regular. They are almost always parallel and well separated when the price is nicely trending. And these two lines have another important feature. They are not so sensitive to pullbacks. Of course, at some point when we will have a deeper pullback, these two lines will follow that pullback. But with small pullbacks, these two lines are not sensitive to them. And then we have here at the bottom of the chart what we call the companion indicator, which is made of two lines, a fast line, a fast bias and a slow bias. And the fast bias is used to confirm some types of entry setups we have, and the slow bias in green and red represent the direction we have to consider to trade. And for example here, just after the Tokyo Open, the trend direction was upward, and so we had to consider only long trade until that point when we had a trend reversal. And so the entire trend to trade, the entire movement was all that movement starting from this entry setup bar up to that candle here, which was our exit setup bar. And so the movement was that entire movement we could have been able to trade with any level of the max. And on this example, I show especially the comparison between the classic MAX primer and the MAX ETF primer. It happens in this example, and this is amazing, that with the classic MAX primer it has been impossible to trade that movement. We had no classic entry setup. And with the MAX ETF primer we have been able to catch the movement almost at its beginning. We never advise to catch movement before the Tokyo Open during the ASEAN session, because before the Tokyo Open we have the price most of the time making small ranges, and so it's a waste of time to stay in these in that period of time, in the trade in that period of time. And with the MAX ETF primer, so we had a nice entry setup here. We had a rather large stop loss, 33 pips, and then the first exit was taken here. And that exit, in fact, is called an MX, which means a minor exit. And a minor exit represents, so closing half of the trade. Whenever we open a trade with an entry setup, we consider the trade is made of 2 units, whatever the size of the trade. We have a procedure to define the size of the trade with the concept of position sizing, but we consider that the trade is made of 2 units in such a way that when we have an exit setup triggering, we can close just 1 unit, and then we keep 1 open unit, so to close it either on the next exit setup or when we have a movement invalidation or the trend reversal. In this case we have had in fact a movement invalidation just 1 bar before a trend reversal. So we had a nice confluence between movement invalidation and a trend reversal. And so at which moment we have closed the second unit of the trade. And you can see that the trade has been a very nice trade, a trade of 222 pips, which represent with a stop loss of 33 pips, a reward to risk ratio of 3.36 R. R representing the risk we use for the trade. It may be 1%, it may be 2%, it's the risk you want in percentage of your trading account. And so this is an example of how the MAX ETF primer is able to trade that movement. With the MAX standard, on the contrary, we have the possibility, like it is shown here in this next slide, to add progressively to the trade. We have the same entry, of course, we have the same stop loss size, and again that movement was not tradable with the classic MAX standard level. We had no entry setup along that movement, simply because the price was moving too fast. The price has reversed too fast to give us an appropriate entry setup. But with the MAX ETF standard, so after the entry, we had a nice opportunity here to make what we call a scale-in. A scale-in consists in adding 2 units to our position. The size of these 2 units are the same as the initial 2 units. So at that point, we have 4 open units. Later on, we had another scale-in opportunity. At that point, we had 6 open units. And then we have our MX. We close 1 unit, followed a few minutes after by another scale-ins, and then another MX, and then another scale-in, another MX, another scale-in. This one was a little bit risky, and we can see that on our chart with some additional indicator we have in our template, but it was still acceptable to take it, and then 2 other MX before the final XXX when we close all the remaining open units. At that point, we had 7 opened unit close with the final close here. And by adding progressively to that position along the trend, in fact, instead of catching a 222 pips like in the previous example, we have been able to catch, in fact, 680 pips, so more than 3 times the result of the MAX ETF primer for a nice 10.3 R profit. This means that if your risk is 2% per trade, in this case, this trade, which has lasted from the Tokyo Open to just before the Frankfurt Open, so it's a time of around 5 hours trading. So with a risk of 2%, this represents a nice profit of 20% on your account, 20% on your account. And so this shows the difference between, first of all, the classic max and the ETF max, and then the difference between the primer and the standard level. The standard level includes the scaling and the scale out mechanism. And this was an example, a trade made yesterday, so Friday. Some other example, this is the pound Aussie, with exactly the same type of chart here, of course, and the same type of information. Again, with a nice max price level here. We have made an entry above that price level, but far enough to be able to take the trade with a very small stop loss, 17 pips. And then a first exit here, a second exit here, so a first trade, and then a second trade here with the same mechanism, an entry, an MX, and a final X we name an XXX. So with the MAX ETF primer, we have been able to make 2 trades, and you see the type of result we have obtained with that trade. And again, it was a movement not tradable with the max, the classic max. And so a total of 2.84 R result. On this chart, I also show what we call a red magic box. The name of red magic box has been given by some of our past max graduates, because when we are trading a specific type of movement I call a true trend, and in the course we define exactly what a true trend is, we know when this movement will exhaust with a 75% probability. And so when we are in such type of movement, we know how to define that red magic box, which represent, in fact, a time period when this movement will have that 75% probability to exhaust. And you can observe here that we were right on time, because for the rest of the day, the price has made a small pullback and then has ranged until the end of the day. So the same movement now traded with and you can see that again the trade was in the direction of the slow bias, which was given downside trade, so a short trade opportunity. And so the same movement now traded with the max standard level, so as given the following result. So with the classic max, this movement was tradable starting from this point, named a short classic BO re-entry at this point. The white notations represent the different steps of that trade with the max, the classic max trend. So an entry here, an MX on this point, a scale in, an MX, another MX, a scale in, an MX, an MX, and our XXX, which is the final exit. So, and for a total of 125 pips, so representing not a big reward to risk ratio, 1.56 R, but still a decent reward to risk ratio. But with the ETF standard, the entry was possible way earlier here, and with one additional scaling. And so we had in total 3 scale-ins, and that additional scaling, that earlier entry, and a smaller stop loss, this make a huge difference in the reward to risk ratio. First of all, the result in pips is more than the double of the result with the classic max standard, but more importantly, the reward to risk ratio is way more important, 9.5 R instead of 1.56 R, and with no additional risk. And in the course, we show that we have no additional risk when we trade that way. We pay an extreme attention to the way to control the risk. And what is counterintuitive, and we demonstrate it in the course, is the way we make our scale-in and scale-out will in fact very quickly set the trade not in a high-risk position but in a risk-free position. And this is the power of our trade risk management. It helps whatever the number of scale-in we do and MX we do in our trade, very quickly the risk is reduced and then we are in a risk-free trade. So the same, another example, so we are now on another pair. I will not go into the details. Here you have understood, I think, the mechanism. So this down movement with the classic max primer has given 3 trades with a total of a little less than 2 hours profit, but with the ETF primer, because the entry the entry has allowed to give an additional trade compared to the max, the classic max primer. So the reward to risk ratio was a little more than 2 hours. And the same movement traded with the ETF standard or the classic standard has given, as you can see, higher rework to risk ratio, and again with the max ETF, a way larger rework to risk ratio, 8.16 R rework to risk ratio in this example. So again, when you take a 2% risk per trade, this represents a nice increase of your account when you are able to catch several trades of that type during the week. And I recall you that on average each pair gives 2 or 3 such trend per week. So on average, so you have plenty of opportunity to catch this kind of reward to risk ratio. The example I have shown up to now are in the 5-minute time frame, but of course any time frame can be exploited. This is an example in the daily time frame. It is the pound Aussie, and so we have this movement here, which was made of a counter trend movement. A counter trend movement is a movement of the price going back to the long-term moving average. And this counter trend movement is followed by a trend which continues the counter trend portion as defined by the classic max. And in the classic max primer, we don't have the possibility to trade that counter trend movement. So we were able to trade only that movement, but not with the primer, with the standard level. And so with the primer there was no trade in this movement, and with the classic we had a very tiny trade here with a very small rework to risk ratio. But with the ETF the story is completely different, because in the way we have redefined the concept of trend, we are able now to trade any kind of movement, and especially when a movement is made with a portion of a counter trend and a portion of a classic trend. And so you can see the 2 types of trades, one with the max ETF primer with the white notation, so to trade with 2.7 R reward to risk ratio, but with the standard level, the ETF standard level, with the scaling technique. So we have made 4 scale-ins, and so in this case we produce a result. It was a huge trade with more than 4,800 pips, but it is in the daily time frame. So don't be necessarily impressed by the fact that a trade can make thousands of pips in the daily time frame. It's very, very common and usual. What is much more important is the rework to risk ratio. Of course, with a higher time frame, your stop loss will be larger, in this case 330 pips, so giving a rework to risk ratio of 7.28 R. So a nice rework to risk ratio in the daily time frame, with a trade having lasted so a few days, starting from the 17th of March up to the 2nd of May approximately, so around 1.5 months approximately. So the max is applicable so to any market, to any time frame. So it may be applied also to indices. For example, we have max graduates trading the DAX, trading the FTSE. We have other trading gold or trading crude oil, and so we have other trading stocks also. So any market can be traded provided the market, of course, presents enough liquidities to trade. I have said we don't have, of course, a 100% winning rate. The winning rate of the MAX is around 75%. When we have winning trade, we may have very often extremely large reward to risk ratio. I have shown just some typical example. When we have a losing trade, and this is the most important aspect of the MAX, when we have a losing trade, the loss is always a small loss. With the MAX, we have the guarantee that the loss will be always a small one. This is a typical example of a losing trade. At some point, we have an entry set up here to take a short trade, and immediately after the trade has been opened, this is something every trader has experienced, the price turns against the trade, and following the rules, we have been able to first of all close one unit with a small loss, 8 pips, and then later the price continued to go against the trade, and we have closed the second unit with another loss, but still a small loss, minus 14 pips. So the total loss was 22 pips, but the reward to risk ratio is minus 0.46R. It is not minus 46R, it is minus 0.46R. So just a little less than minus half R. This means that with a risk of 2%, the loss on the account is less than 1%, which is a very, very acceptable loss. And so this is the kind of loss we have with the MAX. So always around 0.4, 0.5 R as with a negative number. And so this kind of loss can be a little larger, but not so much, a little larger when we have one scale in the trade and then when the price goes against the trade. So with the MAX, we apply that idea or that concept of cutting the loss very short and let the profit runs. In fact, we try to stay in the trade as long as the trend is valid. But of course, even if the trend is valid, if we have a high volatility, for example, sometimes we can get a larger pullback forcing us to close the trade, because once the price begins a pullback, we never know how far the price can go. It may be a trend reversal, and if it is a trend reversal, we do not want to stay against that possible trend reversal. So we have to consider how to cut a losing trade very, very short. Our stop loss, as you have noted most probably, is called an ESL. ESL means an emergency stop loss. An emergency stop loss is there to protect not necessarily, not only, I should say, the trade, but also the trading account. When we trade, we never know what may happen. We may have, for example, an internet disconnection. If this happens, we are blind with our trade. We don't know what is happening. And another problem we may have is we cannot, for example, contact our broker to know what is happening with the trade. And so the stop loss here, the emergency stop loss, is called emergency precisely in this case, just to protect the account if the price continue to go against the trade and hit the stop loss. In such a case, we have the guarantee to never make a loss larger than the size of the stop loss. And of course, the trade size is calculated also with that emergency stop loss size. But the aim when we trade live, when we are able to handle the trade manually, so the aim is to never let the price hit our emergency stop loss. In the case of a movement going against the trade, we want to be able to close the trade before the stop loss in order to reduce the loss on the trade. And what we do also with the MAX is to try to identify as fast as possible the market conditions for the pairs we are trading. With the MAX, we define several types of market conditions we call price modes. And so we define what a trend mode is, we define what a counter trend mode is, we define what a consolidation zone is, among which we have to make the distinction between a large and a tight consolidation zone. We define also what is a choppy market. And most of our entry setups are in a trend mode, sometimes in a counter trend mode, sometimes also in a consolidation zone mode. And when you recognize a choppy mode, in fact, the advantage of recognizing the choppy mode is in a choppy mode we have, with the classic MAX, extremely few valid entry setup. But with the ETF, we have more potential entry setup. But once we have, but they are not so numerous, so they are still not so frequent. But when we have one, because they are not so frequent, we have two choices. Either we can trade that setup in a choppy mode, or we can decide to skip it. But if we decide to trade it, we have to trade it in a very specific way in order to optimize the result on that trade, either by minimizing the loss in case of a losing trade or by optimizing the profit in case of a profitable trade. Because the feature of a choppy market, as its name says, it's choppy. The price moves in a complete erratic way. It can make some ample movement relatively to the general movement, but it can make also small movement. But what you will observe is the price will reverse very frequently with no specific directional bias, in fact. And because we have a price which has a complete erratic behavior, trading in a choppy market is extremely difficult. And so we have a procedure to handle such kind of trade. And we have a specific market price mode, which we call a spaghetti zone. And in a spaghetti zone, we can say that it is a combination between a choppy market and a consolidation zone mode, and it is generally a very tight range, which may last many bars. By the way, it can last also several hours. But the advantage of recognizing a spaghetti zone is we have never ever a valid entry setup in such a spaghetti zone. We are forced to wait for the breakout or the breakdown of a spaghetti zone before considering a valid trade. So it is important with the MAX to recognize in which price mode the price is moving, because the price mode will influence the way we make our entry. We don't trade an entry setup the same way in a tight or in a large consolidation zone mode than in a trend mode, for example, and additionally then in a choppy mode. So I have said that with the MAX we have a winning rate of approximately 75%, and with the MAX ETF primer, the average trade result of a winning trade is between 0.5 R and 1 R, sometimes a little larger, but on average between 0.5 R and 1 R. A losing trade on average will be around minus 0.5 R. And we have so 75% winning trade, 75% winning rate, around 15% losing rate, and around 10% break-even trade, whatever the level of the MAX you use. The difference between the ETF primer and the ETF standard is in the reward to risk ratio. On average, a winning trade with the MAX ETF standard has a reward to risk ratio around 3 hours, sometimes even more than 3 hours. A losing trade is always around minus 0.5 R. And so when you get such kind of reward to risk ratio, you can consider to compound your result, your profits, in order to grow faster your account. And just to show you how compounding can be extremely useful and powerful to grow an account, let me show you just quickly a small example of what we can do. What I'm showing here is a spreadsheet we have with the MAX. So, and this spreadsheet helps to make some projection of the type of result we can obtain in the future. If we consider we have a trading account of, let's say, $10,000, and we use a risk of 2% per trade, we will have to make some assumptions to get an idea of what we can obtain as a growth of our account. Let's suppose that we have an average stop loss of 30 pips. Usually the stop loss will be smaller than 30 pips with the MAX ETF, but let's take that average of 30 pips. And let's suppose that we are able to make every day an average of 1 hour profit. 1 hour profit. This means, so a number of pips, of 60 pips, in fact, for one trade or for several trades. The number of trades that is irrelevant. What is important here is the total result of all the trades we make during the day, for example. And so 60 pips. Knowing that we are using 2 units per trade, so the reward to risk ratio is 1R, because we have to divide 60 pips by 2 to have the average result of the trade. So this gives 30 pips, and when we divide 30 pips by 30, which is the size of the stop loss, we get that reward to risk ratio of 1R. This means, in fact, a 2% profit on that trade. 60 pips is not so difficult to obtain. I don't say it is easy, because trading has some challenges each trader must overcome, but it is not so difficult. The challenge comes from something else. It comes from the psychological problem the trader may have, but it comes also with the intensity of trading. It's not necessarily true that a trader is able to trade every day. This is one first difficulty. So personally, on average, I trade only 2 or 3 days per week. It is not really obvious that you will be able to make the result, the objective, every day. Some days you will make more, some days you will make exactly the objective, some days you will make less, and some days you will have a loss, a small loss, but a loss. And so what I'm showing here is just a raw idea of you can obtain. And the objective will be, for example, to double the trading account, so to get the account to 20,000 US dollar instead of 10,000. And the question is, if we make no withdrawal every month or every period, how many days do we need to double the account? So given these strong assumptions, so making a 1R profit every day through one or several trades, trading every day, okay, so it takes around 2 months to double the account, in fact 36 days. And this gives you an idea on how fast you can increase your account. Indeed, after 36 days, you can see that the account has jumped to $20,000 and a few more dollars. So, and so the question is, how can you get such kind of results? You need, when you trade, to focus not on the result of each trade. You need to focus on the process to handle the trade, applying correctly the concept and the rules of the MAX. If you apply the rules correctly, so if you focus on the process we teach in the MAX courses, then the profits will follow by themselves. If instead you focus on the result of the trade, you will always end up closing your trade too early. And most of the time, you will get losing trades. And so you will never be able to grow your account. The process, the consistency must be in the process and not in the result. For the result of the trade, you have to accept what the market gives you. If the market produces small movement, you will have small trades. If the market produces large movement, you will have large trades and large results. But so the consistency must be in the way you apply the process. The quality is in the process. And just to give you another small idea on how you can quickly grow an account, if you are able to make on average every day just 0.5% profit, so every day, if you use a risk of 2% per trade, this represents 1/4 of that risk, okay? And if you trade every day, at the end of the year, you multiply your account by 3, which is still amazing. If you are able to make on average 1% per day, at the end of the year, you multiply, if you trade every day, you multiply your account by 10. And so this gives you an idea on how an account can be grown trading with the MAX. So the MAX courses are organized in 5 levels. The first level is the MAX ETF primer course. Chris, in a moment, will give you a little more details about all these levels. So we begin with the MAX primer, then the MAX Lite, the MAX Standard, which is the first level where the scaling technique, the scaling process and the scale-out process is taught in details. Then we have the MAX ETF advanced course. In that advanced course, we teach more advanced concepts, essentially to view the market in a more global perspective and to fine-tune some decisions based on some details, more advanced details price movement is exhibiting. And then the last level is the MAX ETF SAM, when we go even deeper into the details by using other types of chart like a constant range bar chart and Renko bar chart. But this is a specific topic, so but it is a level of the course by itself which provides even further profit in profitable conditions. So 5 levels of the course, and we propose to you today the MAX ETF Primer course and the MAX ETF Standard course, but more information in a moment. So in conclusion, with the MAX ETF, whatever the level you want to study, so you will have exceptional trading methodology based on sound concepts. And during the course, we explain why these concepts work. And for many of them, we explain how they relate to the behavior of the big boys in the markets. This is why they work, in fact. And our training session focus on important aspects. Of course, even if we use several indicators within the MAX, we don't trade the indicator, we trade the price action. The indicators are there as tools to help us to pinpoint faster possible opportunities, and I say possible opportunities or possible risky situation. And so the opportunity will be pinpointed with potential entry setups, and the risky situation will be pinpointed with exit setups. Then we have associated with the MAX itself, so a very strong money management and a very strong trade risk management, as I have just explained previously, how we focus first of all on the risk when we are in a trade. So this is what, in which way I can describe what the MAX ETF trading system is. If you have any question, please feel free to post your question in the question area of the GoToWebinar, and we will be glad to answer all of them. And now it's my pleasure to pass the mic to Chris for the rest of the presentation. Chris, up to you.
Okay, thanks Eusebio. Hello everybody, my name's Chris. I'm based in New Zealand, and it's a chilly spring morning down here at the moment, so hello. This is just to give you a bit of background about the training itself. This will be the 61st set of MAX courses. So Eusebio is running most of them. I run, thanks Eusebio. So we've had quite a bit of practice at this kind of thing. And we've trained over 2,000 people since 2008. So just to give you an idea on how long we've been around, we kind of know what we're talking about. Next chart, please. Page, thanks, Eusebio. It's early morning, so I'm still warming up here. One of the things that sets the MAX apart from pretty much every other training course that I've come across is that we ask you to do homework. The reason for that is so that we can verify that you've understood things correctly. When I was listening to Jim right at the very start and other trainers, they would say things and I think, yep, I understand that. But it wasn't until somebody else came from the outside and said, no, you're looking at the wrong indicator, or you've got this upside down, that I thought I had it right, but I had it completely wrong. And so we ask you to do the homework so that we can make sure that you haven't got sort of things upside down. Okay, so here's what the homework looks like. We go through the course, or the session, and at the end of the session you're asked to, okay, show us some examples of what we've been talking about today. Here is an example of what homework looks like. We've got a setup with a breakout and an entry point, that little slash. So it's pretty simple, and you send that in and we can read that, and you will be able to as well, and then the instructor will reply to it. So here's a couple of examples of some replies. So here's an example of what the course comparisons are like. The first two columns that are there, ETF Primer and ETF Standard, are the ones that we're offering today. So the ETF Primer is, just to give you a taste of what we're like, The ETF Standard is our flagship. It's the basis from which all the other courses are built. And I really recommend that you go for the Standard. It's a 7-day course, a 7-week course, sorry. And because it's almost 2 months in length, it gives you plenty of opportunities to send in homework, to see lots of different chart examples, to get lots of feedback. And so when you're learning it, you actually learn it quite a good depth and detail because you're quite embedded in the course. The ETF Primer is just a taste. It's only a couple of weeks. You're taught only a few entries compared to the Standard. And you only get a couple of opportunities for the home. One of our students showed what he did trading the FTSE on a 15-minute chart, swing trading over 4 days, and he was able to increase his account by about 25%. And he had a very small amount that he risked at the start. I think it was 1 or 2%. I can't remember. I'm watching the chat session. He'll let me know what it was. Okay, enough of that. So there can be really good, amazing profits at the result of this, but you don't need to go for those right from the start, so long as you're consistent with what you're doing. And being consistent means following the rules. So long as you follow the rules, you get into the trade properly, and you exit properly, then you're looking after the risk side, and the profits will come naturally. Oh, thanks, Jan. He risked 1% on that trade and made 25% from the trade. So if he'd put $100 on the trade, if his stop loss had been hit and he lost $100, that's what his risk was, regardless of how big the account was. He would have made $2,500 at the end of that trade, so 25 times. Okay, both the Primer and the Standard have homework. You don't have to do it, but I really, really recommend it. It's what makes this course different and what will help. And if you have any questions, please ask in the chat area. So our MAX courses are, as you can see, are detailed and precise, and with the amount of information Eusebio has given out, you get some idea on what the courses are like as well. We use MetaTrader platform to train on. This is because it's free, everybody has access to it. We provide all the course materials, there's no extra hidden costs here. Each of the courses has got homework, like I've been going on about, to really cement the information going in so that it's not just a course that sits in the drawer or hard drive after you've taken it. We want to make sure that you actually get benefit from this stuff. Once the course is done, we have the practice sessions most weekends. Another follow-up is the MAX forum, where there's videos and QA and charts and indicators. So our aims here, again, is to give you a really solid trading method to help you with as much support as you can get. And trading is not easy, but to help you with this as much as we can. So if you ask us questions, we will reply to you. What we've got on, what we're offering today is the MAX ETF Standard. It has the profit acceleration techniques, money management, account protection, and it uses Eusebio's new method of trading trends called ETF. It starts in November, runs for 7 weeks, November the 9th, and the normal price is $2,999, but we have a webinar special for $2,399, and if you contact Craig, he can sort you out with some payment plans. Not too sure how they work, it's up to each individual to sort of talk to Craig about that. If you want to do all 3 courses, the Primer, the Light, and the Standard, then you can do that for $2,679. It's quite a reduction down from over $3,000. So, and there's payment plans for that. So the training package deal, the 3 courses, would run for pretty much 4 months. 1 month for Primer, 1 month for Light, and 2 months for the Standard, to give you an idea. So it'll give you a really good going over, lots of homework from us. So you should be set for life after that thing. Okay, and there's a link at the bottom there which we'll post in the chat area for you to take advantage of this. Next slide, please, Eusebio. For those of you who just want to see what we're like, and the ETF Primer it'd be the way way to go. It's only 2 sessions. Like I said, it doesn't have all the entries, all the exits, none of the profit acceleration. So it is just a primer course. Still hard work, and you still have homework in it. It runs for 2 sessions. The regular price is $329, but we've got the webinar special on at $159. Just to the, for this offering here. And if you wanted to do primer plus light and forget about the standard, don't know why you would do that, but it's $759. At any time you can upgrade your courses along the way as well, so just contact Craig about that. Super flexible on those sorts of things. Okay, so that pretty much is it on our main presentation front. If you have any questions, we'd be more than happy to answer them. Some people have already written in and asked for some answers on some of their worries. Chop versus consolidation. How do I tell the difference between a chop market and a consolidating market?
Yeah, we have in fact rules to define the price modes, and so we have a set of criteria to define what is a trend mode, what is a counter trend mode, what is a consolidation zone mode, what is a choppy mode, and what is a spaghetti zone. However, sometimes we may have a confluence between 2 modes, and this is why within the MAX we define 2 types of modes. We define what we call the local price modes and the global price modes. In the local price mode, we have the trend mode, we have the counter trend mode, and we have the consolidation zone mode. And in the global price mode, we have the choppy mode and the spaghetti zone. So this means that we can be, for example, in a consolidation zone mode or in a trend mode as a local price mode, but also in a choppy mode as a global price mode. And so we are able with our rules to make that distinction. So.
Okay, thanks. Okay. Okay, other questions? My biggest question is what precise strategy to trade, or how do I identify the appropriate entry and exit points? But essentially that's what we supply the training for, so that you know which strategy or trading method to use at a particular point, and where the entry and the exit points for that particular trade that you've just entered into, where they exist. So I guess I've answered that one. How do I improve my odds of staying in a trade that is starting to run? I seem to get whipped about like a rag doll some mornings. Welcome to my world. Xavier, you can answer that one.
Yeah, in fact, this is. I have said previously that trading is also a psychological game, and the problem many traders have is to have not confidence in the trading system they are using, and there are several reasons for them. First of all, it's really difficult to predict where the price will go and how long a trend will last. The second point is when we are in a trade and we see the trade is potentially profitable, and then suddenly we see a pullback. And pullbacks are normal in a trend. We can say that a trend is a successful of failed trend reversal, and a failed trend reversal is a pullback. But when we see such a pullback, a portion of the profit is disappearing, and so many traders will be afraid of that behavior, and they will close their trade to try to protect as much profit as possible, and then they will regret to have exited their trade too early because they see later that the trend continued to go way farther. And so the uncertainty we have in trading in terms of the future price behavior is the big problem. And so in order to help our members to develop that courage or that behavior to stay much more time in the trade, we have developed what we call the companion indicator, which is the indicator I have shown. Let me re-show it very quickly here. It is that indicator here. Not this one. Let me take the example of Friday. Okay, we have developed that indicator here at the bottom of the screen. So, which is the companion indicator, which is it is called the slow bias, and the slow bias in fact gives us the trend and when the trend starts and when the trend ends. And so as long as the trend stays valid, we can stay in the trade. And so we can take the decision, for example, to close the trade only when the trend reverses, provided we have been able to catch the trend, ideally from the beginning or in the middle of the trend. So to stay in the trend, and so in the trade, we can follow our companion indicator. And it is what I do personally. There is also another point. When the price unfolds a certain type of trend, we know exactly in 75% of the case when the trend will exhaust. And so we can stay in that trade and in that trend until the moment we will have a high probability for the trend to exhaust. And so this is just a matter of knowledge of the price behavior and what is the information the slow bias gives us when we are in the trend. So, okay?
Okay, thanks, Eusebio. Just as an aside, because the questions are sort of drying up a bit, back on the news watch list, it's if you haven't used it or seen it, do so. It's really important for trend followers. When news comes out in the market, people think if they're not aware of what's happening with the news, a lot of people say, the broker was trying to stop hunt me or something like that. In the past, it used to be, could have been so. These days, it's less so, and it's more likely you're not actually paying attention to the news. And these days, the pound is really quite jumpy. Somebody will say, yes, Brexit's all on, and the pound will jump up 80 pips, and no, Brexit's off, and it'll jump up 80 pips. And you don't know when they're going to make these funny statements. So you've got to be really careful trading the pound, number one. Number two is for the times when the news is coming out, we produce this news watch list at no cost, and it's really important. If I'd known this right at the start, it would have helped me, saved me a huge amount of money.
You can note, for example, that the example I have shown from Friday yesterday was the pound kiwi, and the pound kiwi was in the suggested pairs for Friday. And if you look at the pound Aussie, the movement was nice also. On the pound USD and the pound yen, the movement were decent too. So these information are useful, and their aim is to give an idea, a good idea, where the action by the big boys may be in the currencies and so in the corresponding pairs through two types of information. First of all, the main news release during the week. Not all the news releases are important. Many of them are not important at all. Some of them are important, and this is what we do in our news watch list. And we have also at the top of the news watch list some elements of geopolitical. We have to pay attention, because if something worsens or improves in these elements, this may have an influence in the market. For example, any announcement for the moment on the Brexit, good or bad announcement, have an impact directly on the pound. And this is why we see such nice movement and sometimes big movement in some pound pairs. So, and for the moment, we have to pay attention especially to what is happening in Germany and in Italy. These two geopolitical, economical events or situations may have in the near future a deep impact in the forex. And so all these information are freely accessible. You can access to the site, to this web, to this address, or I think somewhere on the page you can even subscribe. I don't know if the link is still available. Yeah, you can subscribe here for free. So, to be informed when the page is updated every Saturday.
Okay, thank you. So if you could go back to the pricing, the last pricing sheet. Thanks, Eusebio. No other questions have come through here. Thank you very much for your time. Hope to see you in it. Remember that there's a free live session coming up at the end of this week as well. So thank you very much for your time.
Thank you very much for your participation. So bye everyone, and have a great rest of the weekend, and make nice trade next week. Trade prudently, but trade smart. Bye everyone.